All right, good morning, everyone. Good thing we're can't get any colder with our trainings, right? Being this is our last one, so hopefully the last day of trying to get out here and dust the frost off the vehicles and get ready for training. But we are here at the final session, taking a look at more advanced issues, getting you ready for the advanced certification for the exam. So thank everyone for coming out and providing a great service for actually going up and increasing to advanced level certification so you can actually handle any returns coming into VITA. We're also going to be talking a little bit today about the military training. Again, it's a little specialized training. The session is going to be fairly similar to what we've seen in the past. So if you have an interest in going for military training, we will help you through that process. But just want to kind of go through a couple of issues. The fortunate part, much like the rest of our training, is not a whole lot's changed from last year. I'm going to start off with kind of the only big change that we have in talking about itemized deductions. So as you recall, last year was one of the first times we've seen a reduction in itemized deduction. They've actually moved that to an advanced certification because a lot of clients coming into VITA will no longer be itemizing deductions based on the amount of standard deduction. Now, the one change we do have is in the past couple of years, we've been using 7.5% of AGI for medical expenses. That is now up to 10% for all ages. So that's a new change. We had some reduction in the past couple of years, but for 2019, it's now 10% of adjusted gross income for medical and dental expenses to be considered deductible. And I'll talk a little bit more about that. So the situations you'll probably see the itemized deductions, if at all. Again, that'll be referenced in your 4012 tab F3, which would be our most common. The ones we generally see that people may end up would be those that may have a large amount of medical expense deductions, predominantly people who might be in a skilled or nursing facility, or people who are homeowners. So home ownership can also get you to the path of itemized deduction, but we have some interesting issues that we'll talk about there. The home mortgage loans. So home mortgage loan coming off a 1098. Traditionally, your first mortgage is going to be deductible in full. There are some caps that go into place. If you have a relatively new mortgage, your mortgage balance can't be more than $750,000. I think for our VITA clients, that should not be a problem. We were preparing returns in San Francisco or New York. You may have someone earning less than $65,000 that still has a home that's worth over $1 million because you can't afford anything else. But shouldn't be a problem here in Lancaster County. The one thing we do want to kind of remind people of, and again, it may not be as much of an issue because we're not seeing as many itemized filers, but just to make you aware, home mortgage interest. There are some changes in deductibility for home mortgage interest. In the past several years, it didn't matter how you used the proceeds from your home mortgage interest. It was deductible because your home was securing the debt. With the tax changes we had back in 2017, the only home mortgage interest deductible is any proceeds used to either build, buy, or substantially improve your principal residence or personal residence. So if you're using a home equity loan to go ahead and consolidate debt, pay off student loans, those are no longer deductible as a Schedule A itemized deduction. So we may not see that much coming into VITA, but if you do see someone with multiple 1098s, it generally means they have a first and a secondary mortgage on the property, generally a home equity loan. So if you see a home equity loan or multiple 1098s, you may just want to make an inquiry as to whether or not that the proceeds, how they were used. We don't have to get into a whole lot of detail. If they said, hey, I had a great trip, I finally got to take all the family to Disney, that's fantastic. We just put that 1098 aside and say we won't be able to use it. In all honesty, probably it may not make much of a difference anyway in terms of where we're at with home mortgage interest. Again, when we take a look at a standard deduction for an individual is $12,000. So that's our minimum standard deduction we'll have. So it's a fairly high process there. The other thing that we are not entirely sure of, mortgage insurance premiums. You may recall if you had been volunteering in the past that we had that in prior years. It was not around for 2018. It was actually part of the tax extender package that never happened to get extended. Just based on what's happening in Congress right now, looks like they're a little busy with some other things. So I don't know that we'll see a tax extender package coming out by the end of this year. We'll see if anything happens. For the fact that the extenders were not updated for 2018, I'm not holding a whole lot of confidence that they'll actually come back for 2019. So part of that was the mortgage insurance premium. Again, it's really only going to impact people who are itemizing deductions. The other part of the tax extender in the front of your 4012 are going to be things like the residential energy credit, the tuition and fee deduction instead of the education credit. I don't believe a lot of those we had seen here in VITA otherwise, but we'll update you as soon as we hear any action coming from Congress. In addition to kind of your mortgage interest, real estate taxes are also deductible, as well as state and local income taxes. We'll give you a little bit of a reminder that for tax expenses, you're capped at $10,000 for the year, irrespective of filing status. So between your real estate taxes, your state and local income taxes, you can have no more than $10,000 as a deduction for standard deduction or for itemized deduction. So what we're going to still see, I think, particularly when you have a married couple, when you're looking at $24,000 standard deduction before we put any age or anything else into that mix. If only $10,000 is coming from real estate taxes and state and local taxes, you have $14,000 of expenses to come up with before you get any benefit of an itemized deduction. And if we just talked that your AGI for medical is 10%, it's pretty much coming out of a very, very generous individual who still qualifies to come under VITA. So we may not see that quite as often. But charity is kind of our next area that we may see. Part of it may be considered if you have someone who's been doing a lot of gifting but may not have a lot of income. We'll talk about that implication as well. The AGI limitation for gifting has gone up. You can give up now to 60% of your adjusted gross income to charity and still take that in the current year. We do want to just be cautious of that. If you have people who are very generously minded, we have charitable contribution carry forward, which becomes a little bit of an issue for us to handle. But again, I'm not anticipating we'll see a lot of that within VITA this season. We did talk a little bit more about gambling losses to the extent of gambling winnings. I know when we mentioned about gambling, especially for PA last week, everyone said, oh, what do we do with losses? Well, this is what we do with them. We get to take them as a Schedule A itemized deduction. As you probably can tell, that may not help us in VITA much because most people won't itemize their deduction. So it is eligible for a deduction for itemized purposes only. A little bit more information on tab F11 if you're interested in the gambling losses. It can only offset up to your winnings. The government will not pay you back for anything you lost at the casino. There is no casino insurance opportunity there. So it can go up to your amount of gambling winnings, but it has to be reported on the Schedule A as an itemized deduction. So a couple things what we want to take a look at there are just going through the interview tips. The F3 section goes through pretty well. I think we'll probably show off some legacy people. I know when I've done returns and someone comes in with their shoebox full of CVS receipts and says, I have brought all my expenses in like I was told to. Just kind of use your judgment and figure out whether or not we think that we're going to get over the 10% of AGI and then over their standard deduction. If they have a bunch of, I have all my $2 and $3 copays and I have at least 40 of them here. Well, that's wonderful. But if you do the math pretty quickly, we're not anywhere close to $12,000. And not just 12,000, we need 12,000 plus 10% of your AGI to qualify for medical. So we may not see as much itemized deductions, but just want to remind everyone of going through the process. This is one area that I think we start seeing the documentation rules. Oftentimes people may say, well, here's a listing of my medical expenses. We're fine to use that. We just want to remind the client that we're not the ones that double check their numbers. There's another organization that might do that called the IRS. So just remind taxpayers if they say that I gave $800 to charity this year, as long as it seems reasonable, we can take that information on its face. But just remind people that they need documentation or substantiation of their receipts in case they ever are audited. Generally, if you give more than $250 in one transaction or to a charity that keeps track of that, you'll generally get a year-end acknowledgement. Canceled checks are also acceptable, but we just want to remind people hold on to that documentation. Now, kind of going back to the medical expenses here, one of the things we do want to take a look at are medical expenses are qualifying for a lot of individuals. So we're taking a look at the taxpayer, spouse, dependents, and we're also taking a look at payments made to people who may have been a dependent, but they did not meet all the qualifications. Predominantly, it's where we come under that gross income test. So you may have a situation where someone may have still be paying health insurance. Where we may see this or maybe children who are in that situation where their gross income is too high, that they're not a qualifying relative, but they're still actually under the parent's insurance because up to the age of 26, they can still be on parent's insurance. Those medical expenses still count, even if they're not a dependent on the parent's return. So if they would have met the other tests, but they don't meet the gross income test, they're fine. Can also happen at times if you're paying expenses for an elderly parent or someone else who is over the gross income threshold, would still be considered a dependent, but their gross income is too high, they can qualify as well. So it expands that a little bit. The types of ones we're looking at are traditionally our medical costs. Again, in today's day and age with, of course, 2019, we had a slight change that we're no longer required to have medical insurance. But in a lot of cases, we're not seeing a lot of those significant out-of-pocket costs when people had insurance. So medical costs generally could help with getting you to an itemized deduction, but it all depends if they're usually significant. Dental work can also be there, things like your long-term care premiums, prescription medication and other drugs, and medical mileage. There is a table in your Pub 17, 21-1. If you're ever interested in going through, there's actually a mini chart as well on F5 at the very bottom, just to help go through what is deductible and what is not. So certain things, again, long-term care insurance, we may see that coming through for individuals who are eligible. Usually it's kind of those other procedures that may get people into the qualifying medical expenses, things like eye surgery, significant dental work, that type of thing. Any type of fee paid for long-term care. Usually you'll get a statement from the retirement facility indicating what portion is considered medical cost, whether that's an entry fee or an annual fee itself. Medicare Part D premiums count for this as well. And again, taking a look at other things that may not be covered by insurance, hearing aids, eyeglasses, exams, contacts, those sorts of things, false teeth. Things that don't count, anything for your general health. So you cannot deduct food. If you say, I'm trying to eat healthier and I have to go to Whole Foods and it costs $17 for one apple, that is not a deductible expense. That is purely living expenses. Same thing with health and social activities. So health club, gym memberships are not deductible. If your doctor says you should go out dancing more, that's great. That's not a medical prescription. So social activities generally are not deductible. If someone says, I highly suggest you go to the South for the winter, pick your choice, Arizona or Florida, that's great. It's nice to be down there, but it's not a medical deduction unless it's medically necessary. I don't think we'll see a whole lot of those here in VITA anyway. As a reminder, only medications you can legally buy with a prescription are deductible. So if you have people who like to use the pharmacy ads that they get on their internet browsers, those are not legal pharmacies. They're coming from out of the country, not deductible. And anything that is not allowed by federal government standards is not deductible either. So if the federal government does not allow the medication to be distributed, it is not deductible. And you don't want to push your clients and then have them ineligible for the American Opportunity Credit if they try to get a large amount of non-licensed pharmaceuticals through their system. So just want to remind you a little bit about the itemized deductions. So I think where we'll probably see it really kind of aspects probably controlled to our homeowners, and even then it's probably going to be our single individuals who might have still a relatively healthy mortgage balance, have a relatively high real estate tax, and have state and local income taxes. Or it may be individuals who are in a skilled care facility that a large amount of their expenses are actually considered medical costs. So oftentimes in a nursing facility, up to 100% of their costs can be considered medical expenses. So moving on to business income, kind of our next section of our advanced topics. So this will be covered within your D14 of your 4012. Again, business income is going to be reported on the Schedule C. For what we're looking at, the IRS is going to be making the Schedule C EZ obsolete. It's really not necessary anymore, so we'll see how TaxSlayer deals with that. It's really not going to have any impact on what we do. It's just really your input's going to be exactly the same, just the sheet you may see might be a Schedule C now instead of a Schedule C EZ. The other thing that's going to be relatively new for self-employment income is we've had in the past, last year was the first year we had what we call the Qualified Business Income Deduction, or QBID, which gives you a 20%, basically a deduction off your taxable income. So if you have $1,000 of business income, the Qualified Business Income Deduction will give you a $200 deduction. So from an income perspective, you're only paying income tax on $800. Self-employment still going to be on $1,000, but it's kind of set up here as they went through some tax changes to try and balance business and individual taxes. There will be a new form most likely populating this year called an 8995A. Again, there was a worksheet that populated last year that you may or may not have noticed. You may or may not even notice the fact that we have an 8995A coming through here. It's just more of a formalized process to go through the calculations. Just as a reminder, a couple things that we take a look at for VITA. Generally, what we're going to be seeing here are probably self-employed individuals, or a little bit more of what we call the gig economy, people who are actually doing a little bit, or for those younger, a side hustle. Really that opportunity to make a little bit more money by doing a couple things outside of their normal profession. Uber, Lyft drivers are quite popular. Maybe people who are providing crafts or supplies on Etsy. Other types of tutoring. We have a lot of opportunities for people to do online education. So you can sign up to be an English tutor online. So we may see a couple more people who are trying to supplement their income by doing self-employment type work. And these are all eligible to be utilized within the VITA program. Couple rules that we have. Generally, we cannot have a business loss. So you cannot generate a loss from this activity, kind of an important concept. We try to take a look at the business expenses. Within VITA here, we try and cap it at $10,000 of business expenses. After that, it becomes a little bit more complex to keep track of all those expenses. So if people have a very significant business that they're running, most likely they may be beyond the capacities of VITA. So we're just saying, basically, if you have someone who has a full-blown construction company, probably VITA may not be their best place to get their taxes done. There are a whole lot of other issues we need to take a look at. The other issue, when you run into a whole lot of business expenses, you may run afoul of what we're allowed to actually work with. So you cannot have employees in your business. You cannot use kind of an inventory method of accounting, which means that you cannot actually be holding and selling inventory. So retail locations, that type of thing would not be permissible. Unfortunately, we cannot handle farm activity. For whatever reason, the 4012 does not have depreciable lives for chicken, and the difference between kind of breeding stock and other animal usage. So we cannot do farm returns. For those of you working in the city, probably not a big deal. For those of you maybe a little on the southern and eastern end of the county, we may be excluding a couple people, but we cannot handle farm activity. Likewise, we cannot handle depreciation. So this would be predominantly for people who may be buying equipment, buying machinery for their business. Think of individuals who might be in lawn care and snow removal. Have to buy equipment that would normally be subject to depreciation. Unfortunately, the VITA rules do not have us allowed to depreciate property. It's a little bit more complex because we have schedules that need to carry forward year after year, which makes it a little bit more difficult for us to work with. Also not included in there would be a home office deduction. We do have the opportunity to do a simplified home office deduction for federal purposes only. So if someone's working out of their home office, you can use a simplified home office. But the rules of a home office are relatively complex because once you start a home office criteria, you may end up setting yourself up for other tax ramifications down the road, including sale of your home, other areas that may run into there as well for both federal and Pennsylvania purposes. And so we have to try and just walk a delicate line there. You can do a simplified home office deduction, which is simply coming up with your square footage of your space that's used exclusively for business. So that doesn't mean the dining room that for 9 months out of the year has all your paperwork on, and for the holidays you quickly shove it all somewhere else. That's not a home office. If you have a spare bedroom, if you have another craft room or something along those lines, typically we may see someone who may have an outbuilding like a garage that might use that for woodworking or other kind of crafts. That would be fine. Again, just use reasonable judgment. If they say they live in a 2,000 square foot home and their home office is 1,800 square feet, it probably doesn't make sense. So just again, take a look at that aspect. Again, we may not see a whole lot of those, but just want to let you know the home office calculation are a little bit more involved, so we cannot do those. 211, again, generally we'll try and screen people when they go through the questions. When they talk about home businesses or self-employment income, they'll try to screen them as best they can. As you may be able to tell, sometimes things slip through. People may not entirely know the answer when they're talking to 211. It's better for us to have them come in and take a look. So what I highly recommend, particularly if you know someone's got a couple more complex issues, perhaps start with the complex issues first. Before you get all excited and say, let me start entering the W-2s and interest and everything else, start with the complex areas. Make sure that they're actually still within scope before you're kind of spending a lot more time than what you need to. So particularly on things like business income might be a good opportunity to kind of talk about things and making sure that people are kind of well within our scope of VITA. So a couple things that we kind of excluded here, but what do we actually get to work with here? Taking a look at our qualifying expenses would be things under D18 of your 4012. So these are traditionally going to be things like advertising. If people want to go ahead and get, they may pay for things like business cards, flyers. Kind of a big thing now might be even if you're paying for Facebook ads, those are deductible. If you want to put a little metal, kind of those little stick-on stickers on the side of your car advertising, those are fine to write off the cost of the sign. Driving around town thinking you're a mobile billboard does not work. So if you put on a little sign to say, I will walk your dog, and you drive to the grocery store, that's not a deductible mileage expense. So kind of getting into the car and truck expenses, what we can do under VITA is use our standard deduction for mileage. So basically all we have to do, fortunately for federal, I think they realize don't do a mid-year change on mileage. It's really difficult to do that because we have to keep track of it. But we have a standard mileage rate for 2019. You can just enter your business mileage. There is a nice little chart within your 4012 that describes our business mileage capabilities. Commuting costs are not deductible. So if you're driving from home to a work location, if you have a separate office and you drive every day from home to work, that's commuting, that's not deductible. It's like everyone else. If you're driving between client locations, that would be a deductible expense. If you have a qualified home office and you have no other business location, then anytime you're driving for business would be deductible. But it has to be for business. Again, if you have a sign on your car that says, I will walk your dog, just because you're driving all over town or you're heading to a kid's soccer game does not mean it's qualified advertising. Those are not business miles. Driving to the dog walking aspect, driving to pick up dog food would be considered deductible mileage, but not just driving around advertising. Any commissions and fees, these would be things, particularly for those that might be using web-related services like an Etsy. If you have to pay a commission or a fee for kind of the use of the program, that would be fine. Business insurance would work. If you have interest that you've taken out, we kind of mentioned about that home equity interest. It may not be deductible for Schedule A, but maybe someone took out a loan for their business. Maybe they wanted to do a couple things. So if it's directly related to the business, that interest would be deductible. Any legal and professional services, usually we won't see these within VITA because if they're paying someone else to get their things done, they're probably staying with someone else to get their things done. But if they decided to become an LLC, if they have any other kind of fees or negotiation of contract, we could certainly see that as well. Oftentimes what we're seeing is a little bit more of what we call e-commerce activity. Someone who might be trying to develop some product or things along those lines, they might have contracts that they need to work out or talk about leases. Office expenses, again, office and home doesn't qualify, but if you have things like computer paper, ink, printers, that type of thing can all qualify for office expenses. If you have to, bless you, if you have to rent any machinery or equipment, that can be deductible. Again, we can't handle depreciation, but if you rented equipment, that would be fine. So oftentimes you may have someone who may be in kind of their normal job is to be working construction. On the weekends, they like to help out by doing painting of homes for some cash. If they have to rent things like scaffolding or other equipment or a paint sprayer, those would be deductible. So if you have someone who does some work on the side, or maybe they do construction, they decide to help out with putting in patios or home improvement, and they have to rent some tools, that would be fine. We just can't do any depreciation. Any repairs or maintenance, so if they have to kind of fix things, that would work. Any other kind of supplies, materials they use within the job, any licenses that they need. Usually, again, we may see this more in kind of a licensed contractor. Hair care would also require licensure. Any travel expenses, if you're traveling for work purposes, you're going to a conference, those can be deductible, and meals, and also utilities. Kind of the big things we take a look at here are trying to understand where those are. Most of these expenses we probably won't see within VITA. These are going to be ones, if you see that someone has something in every one of these categories, they are probably the world's best bookkeeper and probably do not need to come to us to get their taxes done. They probably know how to enter a W-2. They can track how much business mileage they have, or understand their travel expenses for conferences, or have a whole list of their license fees that they paid. But we just want to show you what's going to be within scope. Utilities always get to be a little unique, particularly when we talk about things like cell phones, because cell phone plans are generally a one payment process. So cell phones are always kind of that unique area. For a government perspective, it has to be used for the percentage of business. So if you have a cell phone plan, first thing we take a look at, if someone says, well, I pay $200 a month for a family of 4, Well, guess what? You don't have $200 a month in deductible cell phone coverage. If you have 200 and you have 4 phones, let's divide that by 4, and now we have $50 we're working with. And then we have to take a look at how much of your phone is used for business purposes versus personal. This is how the IRS would go through the process. So if you say 20% of my phone use is for business, guess what? We're now down to $10 a month for cell phone allocation, 20% of $50. So it's just one of those things we need to take a look at. Again, we probably can tell individuals will work with the information you have. We just want to remind you of the rules that it has to be related for business. And we're not the ones that make the final judgment on this. There's going to be another organization that has a lot more scariness than we do. That's the Internal Revenue Service. A couple things we just want to take a look at. Just again, reminding people of their documentation rules. A couple red flags to look for. Completely round numbers. So if someone comes in and says, I have exactly $1,000 in expenses, I have $2,000 in rent, my business miles are 12,000 miles for the year exactly. Like, how'd you come up with that? Well, 1,000 a month. You realize not every month has the same amount of days, right? They're kind of varying a little bit. Generally, these are not good opportunities. Technically, you can use estimates on an income tax return. There's actually nothing wrong with that, except when you have to kind of prove where they're at. You have to have some reasonable basis to say, if I lost a couple of receipts, I'll try and guesstimate where I'm at. The IRS prefers you kind of guess lower than try and guess higher. So round numbers are a little bit of a red flag. So we don't want to be sitting there and having someone just try and come up with numbers out of the air. If we run in a situation and we say, oh, these are deductible, and they say, oh, well, I probably have those expenses. Well, the good thing we can do is say, go home, gather up all your expenses, and come back with all of your lists of what you want us to include in your return. So we don't have to have them sitting there for 2 hours trying to look up their bank statements or trying to pull up their credit card receipts and trying to figure out what they have in business expenses. Perfectly acceptable for you to go ahead and say, here's a list of what can be deductible. How about if you go ahead and take some time and we'll have you reschedule and come back to finish off the return. One of the other things we take a look at, fortunately, I don't think we've seen this in our area too much. We talked a bit about the earned income credit and how powerful that is. The earned income credit is based on how much earned income an individual has. Now, if you don't otherwise have earned income, a great way to come up with earned income is to tell people that you have a cash-only business that doesn't exist, such as babysitting. Or maybe you do want to disclose that you are a provider of recreational medication that's not legally prescribed in the US. Technically, you would have to report taxes on that income. But if you have an individual who comes in and says, I have exactly $14,327 of babysitting income, all in cash, I have no receipts, and I have no way to prove that I got the cash. That's a little bit of a red flag. And not to say that's exactly where the earned income credit is, but what's unique is you have people who are very good at math and can go ahead and go through the permutations and say, based on your fact pattern, here's exactly how much you need in earned income to maximize your earned income credit. And somehow that gets out on Google, which we could probably all check to say what's the maximum amount that we need to get our highest amount of credit. And inevitably someone will come in and say, oh, by the way, here's my self-employment income of exactly this amount that I need to maximize my earned income credit. Again, I don't think we've really seen that too much here within VITA, but just some words of caution. If you get to that situation, you may want to just ask a couple more probing questions about that activity, but just those kinds of things as well. All right, one area that I do want to spend a little bit more time in is kind of our Uber driver category. You do have actually a handout as well, kind of a supplemental sheet that talks a little bit more about what costs are deductible for drivers. So these are actually independent contractors. So if you decide that you'd like to drive around for others, you're an independent contractor. So this would apply to Uber drivers, Lyft drivers. Oftentimes in Lancaster County, we also have people who may drive for certain religious people who don't drive on their own. So people who may drive for the Amish or some certain Mennonite orders may be getting self-employment income. So if you're driving, you're self-employed. No one's withholding taxes for you, which the first time this happens, people are surprised that no one's paid the taxes on their behalf, despite the warnings that when you sign up that you are self-employed. So if you have more than $400 from net earnings, you have to file an income tax return. Oftentimes, depending on your service, you'll be getting a 1099 miscellaneous or a 1099K, which can be used to actually put the information in on your Schedule C. Just a bit of a note, the Amish are not going to issue you a 1099K. They're not paying in credit cards to pay for your travel. So you're more than welcome to go ahead and put your own expenses in or your own receipts that you have. So keep track of all of those. Now, what we're basically going to see is that typically if you're only driving for one service and it's kind of an Uber or Lyft, they'll be issuing you documentation. You'll get a 1099 miscellaneous or 1099K showing how much income you have, and then we want to build our expenses from there. So the expenses that we can use are going to be your car and truck expenses. That's going to be our primary one that we can use at our standard mileage rate. And fortunately, the chart that you have there will kind of talk a little bit more about what those are. Again, personal mileage is not deductible. So driving around town is not deductible. Moving between locations while you have a passenger in the vehicle is fine. So those are deductible, but if it's just personal use, you have to keep track of it. There are a lot of apps that'll actually keep track of your business mileage. There are some that are free, some that we recommend if people are going to get into this on a more regular basis, that they may go with something like a Mile IQ, which can help track their mileage. They can get some reports out of their Lyft or Uber system. They don't always track all their mileage. They're only going to track their revenue miles. But you may have some mileage where you may be taking someone up to the airport and your drive back is going to be deductible because you didn't go to the airport for the Cinnabon or whatever else is up the airport. You're going up there because you actually had a job. And if you're looking and waiting and no one's coming back from Harrisburg back to the Lancaster area and you're driving back, that would be a deductible expense. Uber and Lyft is not going to pick that up because you don't have a passenger in the vehicle at that time, but it would be deductible. So just a reminder, kind of our business mileage. Again, any commissions, credit card fees that come off of those expenses. If you have to get additional insurance, oftentimes it's probably highly recommended that you increase your you increase your insurance on your vehicle or carry some sort of umbrella policy or something else just in case anything happens. Any increase in insurance would be considered a deductible expense. If you have a car loan, you can take a portion of the car loan, whatever it's used for business purposes. Again, office expenses, not that you really have a whole lot of stationery involved with an Uber or Lyft business, but oftentimes you may see someone who says, oh, by the way, I'll have a business card printed that you can get a hold of me instead of going through the Lyft service if you appreciated what we do. Those would be deductible. Any type of supplies. So again, independent contractors, but some Uber and Lyft drivers prefer to have things like mints, little bottles of water. Biggest thing are cleaning supplies. So depending on where and when you drive, it may not be a bad idea to have cleaning supplies on hand to make sure your vehicle stays in operating condition. So that actually means things like car washes can be deductible if you're driving for Uber or Lyft. If you need to clean out your vehicle, if you need to do shampooing. Also, if you need to put protective things down, like a nice terry cloth towel or plastic wrap your vehicle so it stays in good condition. Those can also be considered deductible expenses. And again, what you're going to be seeing is you may have a lot more usage now of a cell phone because any Uber or Lyft driver needs to have a GPS and a way to communicate. So you may have a little bit higher cell phone usage now for an Uber or Lyft driver. Again, we kind of use what the client is telling us in terms of their business percentage and their expenses. And again, just remind them that they need to prove that to the IRS. Oftentimes, that the Uber page is probably going to have a list of all their revenue. They may have some expenses, including their commissions and fees. So we can actually have them pull that up and take a look at it from that aspect. Okay, kind of shifting gears a little bit into our capital gains and losses. Again, another topic here for our advanced discussion. Really no changes we have in the past. So these are still going to have a multiple forms that we have, 8949 for each of our short-term and long-term transactions. There'll be some codes that go along with the transaction here as well. All get reported up to a Schedule D, which then get reported up to the front page of the 1040. So this is the government's way of killing trees. So we have a lot more forms associated, which is why it's nice we do electronic filing. Now, the ones that are actually within scope for VITA are going to be things like our sale of stock, sale of mutual funds, sale of a personal residence. Those are going to be our primary transactions we have. In order to effectively prepare the return, we have to have all of the following items of information. So it has to be the sales price. It's generally not difficult to come up with. The adjusted basis of an asset. So this is where we may run into a little bit of an issue, particularly from a brokerage statement. If you get one that says unknown, that becomes a little bit of an issue for us. We don't know what to do with an unknown because we know they paid something for it. We just don't know what it is. Oftentimes we can usually ask some more questions. Usually the client may not know exactly what it is, but we can perhaps refer them back to their broker or their investment advisor to help come up with a basis for them. We cannot give them a number for their basis. Well, I take that back. We can. The IRS allows us to use a number for basis if we'd like. It's zero. It's really technically not a number for any math professors in here or teachers. Zero is not technically a number, but it is what we can use for the return. They will say you can gladly use nothing as your cost basis. That's probably not the right answer, but that's what we're allowed to use. So if we don't have anything there, it's an unknown, we can use zero. Now, I only say that because if you have a transaction and someone sold $14 worth of stock and basis is unknown, rather than have them come back, you're more than welcome to put zero down, and it probably is not going to change the return. So only for PA, if you get over $33, then you have to pay tax, but if it's 33 or less, you're probably okay. But just one of those things, if we don't have basis information, we should probably have them go back to do some research. We can't actually come up with a number ourselves, so it may be something they have to go back to their broker or financial advisor, or if they're willing to, they can actually go with the zero number and have the return process keep moving. Now, the reason I say that is because our next question here is, what's your holding period, short-term or long-term? So short-term is defined as anything up to 1 year. So short-term transactions are anything up to 1 year. Generally, what's going to happen, we'll know when they bought the item and when they sold it, so the system will automatically calculate. You don't have to put anything else in. If it's greater than 1 year, so it's 1 year and 1 day, it falls into what we call long-term capital gains. And long-term capital gains are actually eligible for a special tax rate. The special tax rate is a very favorable 0%. So you can actually have a 0% taxable gain on your federal capital gains, as long as you're long-term. So the gains are going to be 0, 15, or 20%. We probably won't see any of the 20 here in VITA. You don't have to memorize this. The system will calculate this automatically. It's just one of the ones where if you have a return and you have someone on Social Security and you have capital gains and you take a look and you're like, they have taxable income, but something happened in tax layer. There's no tax, or the tax look a lot lower than what it should be. If they have a lot of capital gains or long-term cap gains, if they have qualified dividends, they actually qualify for special rates. So it may not be a problem with the system. But we need to know their capital holding period. Also, if they have any capital loss carryovers. The only way we know this is if we take a look at their prior year return. So if you have losses on capital gain transactions, you are allowed to offset your capital gains with those losses in full. Once you get back to zero, you can take another $3,000 of capital losses each and every year. If you don't use all of them up, they actually carry forward indefinitely until you pass away. So unfortunately, I've had a client that has a relatively high six-figure capital loss carry forward, around $827,000. So either we come up with a way to go ahead and find a lot of other capital gain activity, or they're going to set a Guinness record for the world's longest living human to go ahead and use that up at $3,000 per year. But if we have that opportunity, you take a look at the prior year return, it's going to show up on your Schedule D as a capital loss carry forward. So hopefully they've come in to VITA before. We'd have that information. If not, they need to bring a copy of their prior year return. The other thing we're going to take a look at is principal residence exclusions. So we'll take a look at that aspect in just a little bit. Just as a kind of reminder here is typically for how we're going to identify whether or not we have any capital gain or loss transactions, we're typically going to get a 1099-B from a broker. And whether that's a direct sale of a security that you held for a dividend reinvestment, or whether you have an investment broker you work with, typically it's going to come on a 1099-B. If you have a managed account, you might actually get a 1099 consolidated, which is actually going to have your 1099 INT, your 1099 DIV, and all your 1099-B transactions. If you get one of those, it's important to take a look at each and every page, because oftentimes the summary will be in the very front, but there's a lot more detail behind it. So we do want to make sure we get a 1099 consolidated. You kind of look through every page and make sure all the transactions are there. We hopefully won't see this, but a 1099-S is going to be issued if you have a sale of a home. So a 1099-S is generally only issued if the transaction believes it's not a principal residence. We don't often see 1099-S's, so I don't know that we'll see any here within VITA, but just to let you know, if you see a 1099-S, that's going to indicate a sale of a home. So generally, from your perspective, if a client hands you a document that has a 1, a 0, and 2 9s on it, it's going to be important. We're going to want to put that somewhere on the return because the government also gets a copy. So again, taking a look at basis, basis for securities or even your home is going to be the original cost of the asset, plus any increases for things that you paid for the asset, including commissions, improvements, any kind of fees along those lines. And generally, brokers have to report basis on their documents now. So it's one of the ways the governments try to track down, because they know the stockbroker knows how much you paid for it. They know how much that the acquired price was. They know how much all the fees were. So a lot more of our documents now, those 1099-Bs, should have all of your stock basis within it. So it makes it a whole lot easier to work with. That's also going to go ahead and allow us to do some coding. So you may notice that they break down their capital gains into a couple different sections called covered and non-covered securities. Generally, all it means is we're going to put an appropriate code in so it knows what part of the 8949 to be reported on. The reason we do that is for matching purposes, because the broker is sending a copy of the statement to the government. A code A means that they're covered securities, meaning that the government knows the sale price and also the basis. So if it's a code A, it means it's a covered security and the government knows exactly how much it was sold for and how much its basis should be. Now, that doesn't prevent them from us failing to put that on there, from asking for the whole amount. They go back to their zero category, even though they have the information. So code A is going to be a covered security. A non-covered security means that it is a sale transaction, but the basis is not reported to the government. So generally, these are all going to be long-term securities that their broker is not required to report the basis to the government. So those are our two main categories, covered and non-covered. So I just want to explain what those look like to you, particularly if you see a consolidated 1099 with a lot of transactions. These are the ones typically you may see where you have a client that has a small brokerage account and the broker thinks they're doing a great job by taking $50 out of every fund every month. And they have 14 pages of capital gain transactions. Good news, you don't have to spend 7 hours inputting every single transaction. Our system does not do well with multiple transactions. It's very good at very one or two kind of transactions, but it's not like it's set up like an Excel spreadsheet. You can just drop everything in. We don't have importing capabilities, even though someone says, hey, my broker said you can download this. Well, that's great. We can't into VITA's program, but we can do summary. So we can do summary information if we have a lot of transactions and the information's reported. So we can actually put, for example, if you have a brokerage account, your name can be brokerage account, short-term covered securities, and just put the total in. Just make sure it looks good. You can put that in, and that will be sufficient for VITA purposes. So if you get one of those that has multiple pages of capital gain detail, we can summarize those. That makes it a little bit easier for everyone. Again, just a reminder, the holding period short-term is anything 1 year or less. Anything over 1 year is going to be long-term. Couple things we take a look at. If you have an inherited security, that actually goes up to fair value at the date of death. So sometimes your broker may know that information. It'll actually go ahead and change that so we don't actually have much gain paid on inherited securities. I do want to just mention sale of principal residence. This is still excludable for federal purposes. And generally, we do not even need to report this on the Form 8949 or the Schedule D. It should only be reported on there if they do not meet the exclusion or they received a 1099-S. Now, you certainly can put it on there, but it actually causes a little bit more confusion if you put it on rather than just leave it off. There is actually a code within TaxSlayer. You can indicate it's a sale of principal residence. But generally, we only use that if you get a 1099-S that shows that you had a sale of a home. Now, the exclusion rules haven't changed at all. They're basically taking a look at use and ownership of the home for 2 of the last 5 years. They do not need to be consecutive years. So we're looking at home ownership and usage. So it's where the taxpayer lived for the majority of the time. They must have owned the home for at least the last 2 of the 5 and lived in the home 2 of the last 5. What this allows for is if you have someone who may have been in a home, they had to vacate the premises, maybe they went to a rehab facility for after a medical procedure, and they've been living in a rehab facility, and then it's determined that they cannot enter their home again. It gives them some flexibility. It gives them an opportunity. If you really want to get confused, the IRS has some examples of how you can actually live in your home but not own it, and then own it but not live in it to meet the 2 of 5 year rules. We're not going to get into that here. Because I've never seen it, and I think it's just something that a congressperson came up with the law, and then the IRS had to figure out some examples of how that works. We're probably not going to see that here. But if you meet the 2 of 5 year rule, Then you have a $250,000 exclusion per taxpayer. So that goes up to $500,000 if you have a married filing jointly couple, which should pretty much cover a lot of the gains we'd see on properties of people qualifying for VITA. Lancaster County's been a fairly strong market here for property increases, but $500,000 still a pretty decent amount to have. One of the ways you can quickly find this out if someone says, oh, by the way, I sold my home this year and moved to a different facility. And this may kind of impact, again, our PA property tax rent rebate we talked about last time. But if you ask, how much did you sell your home for? $240,000. Hey, good news. You don't have anything. Even if you pay nothing for your house and you met the 205-year rule, there is no gain we need to worry about. So how much do we need to take a look at? Oftentimes people may not know how much basis they have. So if you say you sold your home, well, how much basis do you have? They have no idea what you're talking about. Again, we kind of take a look at that factor and say 250,000 or less, we're probably not going to dig any further. But what would be basis from your home? We have to first determine sales price. So sales price would be whatever your home sold for, but we get to take off all those other expenses. So if you're paying realtor commission fees, if you're paying your property tax, those would all be coming off as well. If you had to do any home improvements, any home inspection, those all come off of the sale price. And basis is how much you actually paid for your home and how much you put in for improvements. I will warn you, if someone's lived in their home for 50 years, they have no idea how much they put in their home over the past 50 years. We're not going to ask them to go find receipts for a driveway repaving from 1978. Generally, in most cases within VITA, we're probably going to be under that $250,000 or $500,000 exclusion, so it usually makes it a whole lot easier. If we run into any problems and we have a little bit more complex issue, and especially for advanced certification, simply go ahead and put your hand up and say we need a little bit more time or we have to ask some more questions. They're obviously coming into VITA because they can't handle the return themselves. And we're going to see some in the advanced category that go through very, very easily, some that may have a question or two we need to resolve. So if you run into a situation where someone says, well, I don't really meet the 2 or 5-year test, we need to come up with basis, let's just pause that return a little bit and see what we can do to come up with a better solution of how we can prepare it. Another area that we may run into a little bit of issue, again, this is kind of a general straightforward with a couple exceptions. So this is debt cancellation, tab D59 of your 4012. Oftentimes we may see some situations where individuals may have forgiveness of debt. Often this may arise from credit cards. Now that we're outside of election season, the ads are now reverting back to Black Friday deals, auto end of year sales, and how to eliminate your debt. So if you go through a situation where you may have $2,000 of credit card debt and you go to a credit counseling service and they say, well, we've negotiated with the credit card company, if you pay them $700, they will forgive the other $1,300. Well, guess what? That $1,300 isn't free. The taxpayer used $2,000 worth of credit card money to buy things. If they only have to pay $700 for it, they got $1,300 worth of economic benefit. So that is technically income. And it's going to be income only for federal purposes. It's not income for state or for local. But typically they will receive a 1099-C, which the C stands for cancellation of debt, if they have more than $600 of canceled debt. So if they get a 1099-C, probably the first thing you're going to ask is to say, it looks like you may have had a debt relief or debt forgiveness program. They'll probably say yes. Most of these are going to be within scope. Now, we do need to ask a couple questions. First of all, it's personal debt only. We can't deal with business debt. And in fact, when we take a look at that business opportunity, most of the business questions are going to be too advanced for VITA anyway. Has to be reported on the 1099-C. There's no interest in connection with it, and typically with credit cards, they do not. They're only looking for principal only. Again, not business related. They're not going through bankruptcy, and they're not claiming insolvency exemption. And I'll discuss that in just a little bit. There's actually D60 in your material shows what insolvency is. And insolvency basically means that you owe more money than you're worth. So you have more debt than you have in assets. So theoretically, a homeless person has a higher economic station than you do in life because you owe more than what you have in total assets. Now, under an insolvency exemption, you may be able to exclude part of that debt forgiveness income. Now, that is unfortunately outside the scope of what we can do because the insolvency exemption, the IRS will not let us go through that calculation. However, we do have some resources. If you recall when Becky was in here talking about what they can do with their Mid-Penn Legal Center, they can actually go through the insolvency exemption with a client if it's significant enough that will make an impact. So if someone had a significant amount of debt relief and it may be causing problems with tax payment or other items, that may be something to would be a great referral for them to take a look at insolvency. But insolvency is basically saying that, again, you have more debt than what you have in assets. So even after the debt forgiveness, you're still not back at even, which means you didn't get any economic benefit. So again, that might be a referral opportunity. If they're not claiming it, and a lot of people say, hey, look, it's just, I got a little over my head. I want to have a couple $100 relieved off credit card debt. We can pull that entire amount in as taxable income. It's going to basically show up as other income on the 1040. So it's just going to show up probably moving through Schedule 1 into our other income. Now, we may have a little bit more of an issue if there is sort of a foreclosure. Again, one of the things that's kind of in our tax extender package is qualified income forgiveness of debt. Now, I'm only going to mention this just in case you see it. If you have a taxpayer that comes in and said, my home was foreclosed, we probably still won't have any tax issues. It's just reporting a whole lot differently. So I just want to warn you, the 1099-C is generally going to be used for credit card debt. If someone comes in with the 1099-C because there's a cancellation of a home mortgage loan, we probably want to spend a little bit more time looking at that. Likewise, they may come in with a Form 1099-A. That's another opportunity. That would be indicating a foreclosure or abandonment of a principal residence. So these are within scope for VITA, but we don't see these very often. So if you have someone coming in who's going through a foreclosure or home debt forgiveness, we probably want to spend a little bit more time because we have to go through and identify whether or not the loan's considered recourse or non-recourse. For those of you non-attorneys in here, it's basically whether or not you can go back personally to the individual for the debt or not. So it's a little bit more complex than probably just sitting across the table and talking about those. So a 1099-A or a foreclosure process, we probably want to spend a little bit more time. Certainly go ahead and put your hand up at that point and we'll kind of walk through a couple things. All right, just want to touch a little bit more on some pension and annuity aspects. Couple things that we just wanted to clarify from our earlier session, also kind of show you a little bit more of the advanced topics here within our pension and annuity. Again, we have an opportunity for exclusion for insurance premiums for retired public safety officers. Usually what kind of the retired public safety officer would, they're getting a lot of information from their benefit program to say, here's how much you have in insurance. It's effectively coming out of their program. It's actually deductible. So we can actually reduce their amount of taxable income by the amount of insurance that they're paying. Again, they have to be a retired public safety officer. And we have a little bit more information in Pub 575 in case it's an issue, but we're looking at law enforcement, firefighters, chaplains, rescue squad, ambulance crew that were paid to be a safety officer. They're now retired and they're paying part of their own medical benefits out of their retirement distribution. So you can actually take a deduction, either the amount of the insurance or $3,000, whichever is lower. And there's actually a way within TaxSlayer to go ahead and indicate it's a PSO. Now, some other things we're probably going to take a look at, which the advanced notification helps with, are partly taxable pensions and annuities. So for the most part, a lot of people will get a 1099-R. It's a code 7. Box 1 is going to match box 2A, no problem. So we want to talk about a couple of the other unique areas that kind of arise from pensions and annuities. Just a couple reminders, a couple of the codes that you may see. 7D. 7D is going to be the code for a non-retirement annuity contract. So essentially, if someone has created annuity, typically with a life insurance company or some other investment product, that will be taxable for federal. Code 7 is going to dictate the federal treatment. The code D means it's a non-retirement annuity, which means that same amount of income will be taxable for PA as interest. So that will be taxable. A code F would be a charitable gift annuity. I don't think we see a whole lot of these within VITA, but oftentimes if you sign up for a retirement community, they may say, would you be interested in participating in charitable gift annuity? If that is the case, you also get a 1099-R with the code F. That is taxable for federal and also taxable for Pennsylvania purposes. Code 4 is basically a distribution as a beneficiary. Again, as a reminder, taxable for federal purposes, But even if the individual is under 59 and a half, there is no penalty associated with it. It's on account of inheriting the retirement account. It's also not taxable for Pennsylvania and not taxable for local. So Code F, Code F, Code 7D, taxable for PA, not local. Code 4, not taxable for PA, not taxable for local. All right, so what do we do with those partly taxable 1099-Rs? So we may get a situation where we get a 1099-R and the amount shown as gross distributions different from the amount shown in taxable. And we generally go ahead and work with that information. Someone's already gone ahead and provided that for us. So typically, those are pretty straightforward. If box 1 is different from box 2A, you enter it exactly as shown, and box 2A is going to be the one that actually flows through the return. It may be a little bit different because they may have some investment in the contract, particularly with an annuity or some other type product, so that might be a little bit different. Now, I do want to talk about what happens if there is an investment in contract, and typically you may see that box 2B or 2A says unknown. Or there's something there that we don't know exactly what it is. So typically what we'll do in the very first year of a distribution, we can set up a kind of a way we can recapture some of their investment in contract. The way we typically do that with VITA is something we call the Simplified Method. And this could be for a first year issuance of a retirement plan. Once they start it, you'll go ahead and continue the Simplified Method, which is why we'll want to see prior year returns. So basically what we'll see is that if we have an annuity started after July 1st, 1986, and the Simplified Method was used in a prior year, we continue to use the Simplified Method. It's already done the calculation for us. We're just going to simply carry that forward. It can also apply for brand new recipients where we actually have started the annuity after November 16th, 1996. Not quite sure why we still have something in here from 23 years ago for a brand new. They forgot that they had an annuity for 23 years, as long as it started after November 16, 1996, and any of the following happen, the payments are going to be based out of a qualified plan, 403B plan, an employee annuity, usually coming out of we'll generally see these more coming out of governmental and not-for-profit structures rather than a for-profit. And when the annuity started, either they were under the age of 75 or their guaranteed years is less than 5. So typically where we're going to see a lot of these coming through, in my experience, has been through governmental pension programs, where the employee has actually put some money in, or there's some sort of qualified reduction that they put in that we need to recover part of their initial cost. If we have an investment in contract, we're going to hopefully use the Simplified Method. If they don't qualify for the Simplified Method, we can actually do what we call a general rule. If you see the general rule, it means that you're going to be spending a little bit more time working on that. There's a whole publication, publication 939, which is dedicated to showing how the general rule works. Not to scare anyone, most times we'll probably only see the Simplified Method if it's even applicable. And again, we'll talk about the range in which the Simplified Method will be used. So again, Simplified Method, what we're going to be looking at here is if we have the prior year returns, we'll simply continue that same mechanism as we've had before. So if we have a Simplified Method in the prior years, we'll simply use that same calculation to determine how much of that amount received this year will be excluded. If we are doing it for the first time, we need a little bit more information. So we first have to determine the annuity type. Is it going to be a single life? Is it going to be a joint life? Is it going to be for a life period? Is it going to be over a certain period of years? So we have to figure out the type of payments, whether it's a joint or single life, and whether it's for a term certain or whether it's for a longer period of time. If it's based on a joint life, we need to know the ages of both parties. So typically what we'll have is we'll have the primary annuitant and then a beneficiary. We need to know what their birth dates are. Usually not a big deal because we actually have that in the tax system because they're filing together, which makes it a whole lot easier. So you don't have to ask them a second time what their age is. We actually already have that. The other thing we need to find is on the 1099-R, there is a box 9B, which will show the net investment in contract. So this is typically the total amount of our non-recovered post-tax contributions to the plan. So for the first year, the box 9B is going to be pretty important. So then what we do is we would go ahead and use, I say we, It's really tax layer behind the scenes using the joint annuity tables to do the calculation. So not to have you fear it all we're basically saying is if it's a joint life annuity, we kind of check the box and indicate both are going to be participating. Single life, you check the box and say it's a single life annuity. If it's for a fixed period of time and not referencing any type of age, then we just mainly input the amount of years that annuity will be collected. We don't really see a lot of those because you use simplified method to be 5 years or less. Most of these are for a lifelong period. So a couple things we want to take a look at. I just want to show you a quick example. This is actually coming out of some of your other materials. So you have an individual age 65 getting a retirement annuity under a joint and survivor annuity starting in 2019. He was fortunate enough to start at the beginning of the year, January 1st. Benefits are going to be paid for the life for him and his wife, Kathy, who's also 65. He has $31,000 in qualified plan contributions and has not received anything. He's getting $1,200 a month in annuity. Then Kathy's going to get half of that whenever Bill passes away. So the main questions we have, should the simplified method be used? Yes, because what we're looking at is the annuity starting after November 16th, 1996. It's coming out of a government program and it's going to be paid over a life term. So what we would do, we'd simply enter this information directly in the tax layer. We know it's going to be a joint life annuity. They're going to go ahead and pick up the amount. We don't even care how much they're getting. We just need to know that it's a joint life annuity and the ages of the people when the plan had first started. And we have to put the $31,000 in, which typically, again, would be on line 9B of the 1099-R. And the system will automatically calculate based on the life annuity tables, which is, for those of you who wonder what actuarial science majors do, this is what they come up with, the life tables, and determine how much should be taxable in each year. So this all happens behind the scenes. So what will happen if we take a look, and again, for those of you who enjoy kind of those sausage making tours, what would happen, we go to the joint life annuities. It would determine that the joint life expectancy based on the people running a number of calculations is 310 months. So they would divide the $31,000 by 310 months, which comes up with a $100 reduction from each monthly payment. So what would happen is the system would go ahead and calculate that the amount that they received, the amount in box 1, is going to be reduced by $1,200 for taxable amount on the return. So it's going to go ahead and do the calculation automatically. You don't need to worry about it. It's going to do it automatically. The next year you pick it up, particularly if we've done it in VITA, it's going to know how much is carrying over, and it's going to know how much more of those 310 months you still have left. So really the simplified method is going to go ahead and allow us to do a recovery of cost basis. Again, first year, we just need to know the annuity start date, joint or single life annuity, and pick up the amount from 9B. Once you enter those in the tax layer, it's a pretty simple process to go through. A couple other things I just want to mention on insurance contracts. You may see a couple other codes. Some of these are technically not within scope, but we may see these anyway. A code 6 is basically that someone has exchanged their insurance contract to buy something else, either another insurance product, or typically we may see this for kind of an exchange under a 1035 program. So these are generally not taxable for PA, although PA does get these on occasion and will try to add these back for SP and our rent rebate. So they're considering these as taxable events potentially for SP and REV 1500. Technically the code 6, I believe, is outside the scope of VITA, but if we do prepare the return, or if you're doing one for friends and family, just be aware some of these insurance exchanges, if you're exchanging annuities, PA may treat the taxable amount as income for SP and for our property tax rent rebate. Another one that we can see is actually a code W. This is oftentimes where someone has an insurance contract, usually a universal whole life, and they're using part of the proceeds to pay for long-term care contracts. You can actually have part of your insurance be taken out and paid over for long-term care. You get a code W. These are tax-free for federal, state, and local purposes. So basically, you're converting one insurance policy for another, so there's really no economic gain. A couple things I just want to mention, kind of a reminder of your HSAs. We can have individuals participate in an HSA if they have a high deductible insurance plan. We covered this a little bit during our adjustment and deduction section, but just a reminder, if you're HSA certified, again, probably ranking the tests in terms of ease. The intake sheet may be the easiest one. Ethics, not too far behind it. HSA is probably our third easiest test because there's not a whole lot involved with that. So if you're HSA certified, you can prepare a return. But guess what? There's not really a whole lot of complexity with the HSA piece. You're basically going to get information off the W-2. So if you see a code W in box 12, it means that there's an employer contribution or the employee made pre-tax contributions to their health savings account. So it's basically saying anything that was made pre-tax or by the employer is going to basically reduce the amount of additional deduction opportunities for the employee. They can certainly put more than that in if they want, but basically what you'll see is the form 8889 will be completed. We'll report any of the amounts from the code W that'll automatically flow over. If they decided to put some money in on their own, this is where we enter additional contributions. And contributions would also be deductible for federal and Pennsylvania purposes. Probably a more important area, if they received a 1099 SA for a savings account, it's going to be indicating a distribution from an HSA. Again, most times these can only be used for qualifying medical expenses. So pretty much just confirm with the client that these were used for qualifying medical expenses. Again, probably refer back to our list of things that qualify under itemized deduction, which even though we don't have a whole lot of itemized deduction anymore, those same qualifications will meet the standards for an HSA distribution. So things like doctor visits, co-pays, pharmaceutical products, again, as long as they're legal, eyeglasses, eye surgeries, dental work, orthodontic is all eligible for an HSA distribution. Most times people get an HSA debit card, which can be used predominantly and only at medical service facilities. So basically we have to double check to make sure their 1099 SA was all used for medical expenses. If so, it's very easy in TaxSlayer. You enter the 1099 SA and then say how much do you have in medical expenses. You enter the exact same amount, which means it's not taxable for federal purposes. If for some reason that they say, oh no, hey, I got to use that money. Someone told me, use your HSA because it's just like an IRA. Sort of. But if you're under the age of 65, it's not a good ideal situation. You get a 20% penalty on top of it being taxable income. So if you took money out of your HSA for anything other than qualified medical expenses, it's taxable income and also subject to a 20% penalty. So don't do it. Hopefully our clients didn't do it either. Most cases, they don't know that they actually can request it. Usually they just have their card. So almost in all cases, it's going to be fully excludable from income. Okay, also just wanted to do a quick reminder about military tax issues. Again, nothing's changed. So I believe the fourth year we're actually gonna be qualified to do military returns. This is, again, a separate qualification exam for military returns. Relatively straightforward. We're gonna try and give you all the information you need to be successful on the exam. If you do see one, just kind of indicate that you have one, because I think it'd be good for our site coordinators to take a look at it, and also for us to kind of flag it in our system so that we can better understand how to prepare the returns for trainings in the future. If you're unsure of anything, much like we say with anything in advanced certification, don't be afraid to hold on and ask questions. There's no, it's not like a basic return, someone come in and putting down a W-2 and saying, how long is this gonna take? Not that long. If they come in for an advanced return, it may take a little bit longer, and you may not be able to complete it at the same time that they're there. So no worries about taking some additional time. The reason why they're coming in is because they need help, and we're going to try and provide the best help we possibly can. We may not see a lot of military returns, mainly because we don't live near many direct military active bases, but you may see more activity for people who may be married to a military service member, or people who are in the National Guard or other types of deployment opportunities. The best place for information is going to be off your Pub 4491, which actually is a really good resource as well. It's kind of a nice compendium to the 4012. 4012 is a nice little guide. The 4491, if you have any other questions about things like dependency issues or income, the 4491 is a much more robust guide for taking a look at these more detailed issues. So just a couple things that we want to talk about for the military. DoD will issue a W-2 to every service member coming from the lowest contractor they can possibly find to manage payroll and send out W-2s. So just warning you that I have run into many situations where these things are not entirely correct. These are generally beyond the scope of what we can handle within VITA, but I had a situation where I had a physician in the military who kept getting bonus pay that was supposed to have ceased after a certain period of time and continue to receive a significant amount of bonus pay, which they found about 2 years later and then wanted it all back over a period of time. So just be aware, you may just want to inquire to say, have you heard anything on base about these things not being right before we get too far into the process? But generally what will happen is you'll get a W-2 from the government. Again, what you're going to take a look at, the 4012 on D2 is going to show you the amount of income that's taxable and non-taxable. There's a whole litany of items that would be taxable for basic service pay is going to be taxable, basic housing allowance is not. So a couple things we take a look at. Generally, the military is pretty good about coding these things. They just have a lot more opportunities for compensation than what most employers have. So bonuses, advancement certifications, all those other things, specialized schooling, can all be either includable or not includable in income. If you have any questions, the D2 is probably your best source for that. You're also going to see that the W-2 has a lot of weird stuff on it too, a lot of different codes. Enter them exactly as you see them. Box 14 obviously doesn't really go anywhere. A lot of times you may see some things in there just indicating maybe things like basic housing allowance or retirement contributions, that type of thing. A couple other things we take a look at is with the military, they have a tendency to move people around quite a bit. So moving expenses are actually the only type of moving expenses that are still deductible. So a couple years ago, we removed the moving expense adjustment from the 1040. The only ones who can still take it are active military personnel. There's also a couple unreimbursed employee expenses military members can take as well. Again, special qualification that they have over other employees. So again, what we're looking at for the most part is we're going to see that the W-2 is going to control everything we do from the military. As long as the W-2 has been prepared correctly, we simply enter it as shown and really no additional issues. You may get in a situation where a person is separated from military service under a disability. So we want to take a look at the difference between severance pay versus disability pay. So it all depends on the type of medical discharge you have. If you're discharged for medical reasons, but not considered a disability, that pay is considered taxable. Quite often what will happen is you can go through an appeal process and have a determination of whether or not your disability actually prevents you from working. What we generally see, this process may take a little bit of time. Once that award has changed to be a disability, then your income is no longer taxable. You may have the ability to go back and amend a prior year return to go ahead and get those changed. So we may take a look at that kind of the year that the letter of disability is actually received from the VA. Again, we may not see that very often here in Pennsylvania, but oftentimes people may be coming out of the military, coming out of active service, and still be contesting whether or not it was a medical discharge or a disability issue. So we may still see that here in PA. A couple other things we have, combat pay. If you're in an active combat zone, it's not taxable, so it will be excluded. The one thing we want to mention about this is combat pay is not in box 1. So if someone is in an active combat zone, their combat pay is not in box 1 of the W-2, but it does show up on box 12 with the code Q, meaning it's combat pay. And the reason why it shows up here is that actually is considered earned income for earned income credit purposes. So they can actually use that. So they can, basically, I believe TaxSlayer will default to include it in. You can take it to opt it out if you so choose, but you can actually use your combat pay to increase your earned income credit opportunity. So a little bit more of an applicable situation of someone who's deployed in an active military zone, otherwise have no taxable income, but you can actually treat that as earned income for EIC purposes. A couple other things that are going to be non-taxable would be our homeowner assistance and basic allowance for housing. So they're not reported as taxable income. A couple things I just want to mention here on Pennsylvania. So anything earned by Pennsylvania residents is generally taxable. So if you're getting military pay, it's generally going to be taxable except active military duty pay. So if you're in active military duty pay and you're stationed or training outside PA, it's exempt. Now the caution, again, you may have heard me indicate that the government uses the lowest cost contractor to prepare W-2s. So the W-2 may not always be correct. It may have something that's going a little weird. It may have PA tax withheld. What we generally suggest, if you have someone who comes in and says, I have an issue with what is reported on my PA return, what we want to do is we want to get a copy of their military orders. So their military orders, which they should have access to, will indicate where they were stationed and whether or not it should be taxable for PA. Again, what we want to try and do is take our time with these. It may take a little bit more opportunity for us to get this correct, but we want to get a copy of the military orders along with the W-2. If they don't have their military orders, they can get a statement from their commanding officer. Generally a lot easier to get their military orders, but they can get a CO statement as well. And a little bit more information. PA actually has an entire brochure called the REV 612 that talks about military pay. So there's a lot more information on there about it. If, again, you have any issues, feel free to kind of indicate that to us, and we will go through the process. A couple things that we may see again with military would be, we mentioned kind of some another opportunity they have are expenses. So moving expenses are traditionally not taxable. Generally, moving expenses are covered by the military. Anything that you have called a permanent change in station or PSC would be a, or PCS is not taxable. They are deductible expenses. So those would be moving the cost of your household items, basically personal effects, reasonable travel and lodging. What we typically see is that the military will offer to move for you. So they will move your items and they'll take care of it. Generally, that's not going to be a problem. What we sometimes see is someone says, well, I'll do it myself because I have a friend who has a pickup truck that owes me a favor. I'm going to load everything in there and it's going to be a lot cheaper for us to do that. It's what we call a PPM or personally procured move. So a personally procured move is going to allow us to go ahead and take a look at those situations and say that the military will say, go ahead and move. We will go ahead and pay you 95% of what it's going to cost us. So we'll determine how much it's going to cost us. You go ahead and you submit all of your receipts to us. And if we gave you more money than what it actually cost you, that amount will be taxable. That's going to show up on your W-2. So that amount's going to be shown basically as taxable income. It may be reported even on a separate W-2, but anything you get in addition to what it would have cost you to move is going to be taxable. Last thing I want to mention about military is military does have some additional expenses that they can qualify for. So these, even though we got rid of unreimbursed expenses for federal purposes, military can still take these. So traditionally what we're going to be taking a look at would be things like cleaning, uniform expenses, only if they are not suitable for general use and generally prohibited to be worn while not on duty. So if you are not allowed to wear your uniform while you're not on duty and you have to get things cleaned, a couple of my friends in the military hated getting their shoes shined. So it's a whole process. If you have your military uniform cleaned, it can be deductible expenses. Also, we may see a little bit more in people who are in the reserves here in PA. There's a rule that if you have to travel to your reserve duty station and it's 100 miles away, those travel expenses are deductible. So as long as your military base is more than 100 miles away, you can deduct your travel expenses. If you talk to someone and they are stationed in Indiantown Gap, it's not 100 miles away. It may take a little bit longer to get there, particularly based on Hershey traffic and everything else going on, but it's not 100 miles away. If they have a 100-mile radius, they can actually take that as an adjustment to income. So that can actually be deducted on their return. Same thing if they have dues. If they have to pay dues that are related to military activity, that can be deductible, but not your social dues. So NCO club dues are not deductible, officer club dues not deductible. But if you have something else that you're participating in, that can be considered a deduction. Likewise, education costs. If you're getting additional education or training, typically the military will cover most of those, but if you have some sort of course taken outside, they're going to be fine. However, if you happen to be, say, a pilot and you're trying to become an accountant and move out of the air and move down to the ground, that's not qualifying. That's a new position. And again, what we'll see is a lot of more detail in the 4491 that'll go through some more examples of exactly what we see. So again, for military, kind of what I want to kind of sum up with is traditionally the W-2 is going to control what will be taxable. The main issues we may take a look at would be things where if we have a severance versus disability payment. There may be some issues with moving, and we may have some opportunity for additional deduction coming from a military reserve opportunity, which I think we'll see a lot more people in reserve here for PA.